I know you had this special silver note out. You had a line here that I was hoping you could expand on. Above ground stocks being gobbled up by smart players. We've seen the COMEX registered inventory go down. We've seen the stock in London is going down. Where it's going is a little bit of guesswork. India is importing a lot, but you also mentioned here that there will be a massive crisis in silver at some point, and perhaps you could explain what you're seeing and expecting there. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, part two of my interview with Vince Lanci of Goldfix Substack. Yesterday, he talked about the conditions that the Fed is facing and the awkward corner that they're backed into. And today, he gets into the gold and silver markets and how things are likely to play out there. So, with that said, here's part two of the interview with Vince.
Will we get countries that want the price of gold to move more freely so they can show the value of their storage value? And so, unfortunately, I'm laying out the problem, but I don't have the answer. I mean, what do you think? I mean, do you think, I mean, digitally speaking, does gold stay where it is more or less, or does gold go up like it has gone up in every other currency except the dollar? Like, what happens? I don't know.
Well, I know what you mean, because what really drew me into this 10, 13 years ago was seeing, even aside from the money printing,
Right.
once you see that the debt's being piled on, and if you accept the fact that Pelosi and Schumer and all the other guys, talk about deficit reduction, but once you get to that point where it's like, wow, that may not ever happen,
Right.
someone's getting stiffed on it, and I guess certainly it can go on for a long time. Yet it seems like the U.S. certainly is bankrupt in one sense, and what if it's not going to get paid back? Eventually, there's some sort of negotiation, some sort of restructure. It seems to a large degree that the political response is just pretend it's not there, but
Right.
someone's on
Right.
the other side of that, and I'm sure they're
Right.
not happy about it. And it comes down to what other way of doing it is there.
Well, maybe maybe gold stays the same price, but the dollar just goes down. You know what I mean? Like, gold is still $1,800, but a dollar buys you, the dollar ruble trades parity. I mean, God forbid, but you know what I'm talking about. So the nominal value of gold stays the same, but the buying power explodes. I don't, I have a question for you. When we look at the emerging markets, the emerging markets suffer from our monetary policy. And if you look at them, they're kind of like the natural resource countries. I'm not talking about China. I'm talking about like a smaller country, like maybe a Latin American country, or even like Indonesia or something like that. I'm wondering if tomorrow, the whole point of like the new boss, if it was no longer us in charge and if it was China and Russia in charge, wouldn't they just basically be doing the same thing to the emerging markets there? Wouldn't they want to keep? Doesn't Russia need more manufacturing? Doesn't Russia want to keep the price of gold down relative to the emerging markets so they can buy more of it, so they can grow their own economy domestically? I feel like there will be opportunities to sell gold at a much higher price, but I still feel it becomes the competitor, right? I mean, if they create a basket, if that basket, right, Mark, if that basket has, let's say it's 33% natural gas, 33% oil, and 33% gold. They're fighting for who's got the mix in the basket. I think they end up fighting with each other. I mean, I can't see Russia and China being pals 50 years from now. I just can't, So maybe once they get rid of the dollar, I mean, I'm not wishing this, but I don't see how absolute power just doesn't corrupt absolutely. And that's it. I mean, I don't know. I don't think it's good for us. Just speaking for us, it's not good for us. And it may be better for a citizen of Russia or a citizen of China, but it won't be that much better that their standard of living will come up to ours.
Yeah, it's definitely not an ideal situation all around. And something else I wanted to ask you about, because I know you had this special silver note out, and I'm a big silver fan, wondering if we do get a move in the gold price, that silver would seemingly benefit from that. You had a line here that I was hoping you could expand on: above ground stocks being gobbled up by smart players. We've seen the COMEX registered inventory go down. We've seen the stock in London is going down. Where it's going is a little bit of guesswork. India is importing a lot, but you also mentioned here that there will be a massive crisis in silver at some point, and perhaps you could explain what you're seeing and expecting there. I know you also have a trading background in silver, so it'd be great to
Yeah,
hear about that.
I have risk on in silver right now, and I had a trade on the other day. For a client, so it's not just like it's my own stuff as well as for a fund stuff. Okay, uh, the information the information that I'm seeing that makes me make that statement is based on two different things. One of them is structural, which I'll touch on very quickly, and the other one is mechanical, which we're seeing in the market day to day. And we'll start with the mechanical. On a mechanical basis, on a daily basis, silver spot is, I'm probably backwards to your viewer, but silver spot is here and the futures are there normally, right? In a normal contango market.
Right.
And the reason that is just, is because the cost of storage, the cost of money makes the price go up over time. And the spot in a normative, I should say, nothing's normal anymore, right? In a normal market, silver should be under where the, let's say, 1 month future is. And so you have a contango spread market. Well, things that I saw in 94 when Soros cornered silver, people won't tell you it was Soros, but I will. In 97, when Buffett cornered silver, people will tell you it's Buffett, and I will also tell you it was. What happened was, before those moves, I don't want people to think we're going to go up tomorrow, right? Before those moves, you get backwardation, right? You get your front month future going here and get your 1 year future going there. And that's a comment on we need it now, right? That's supply and demand. We want delivery. We want, where is it? Okay, we have to borrow from here to bring it there. That's kind of what Buffett did. But before that happens, there's a line. This is the US, right? And this is London. And London is where the physical is. And we're just the financial aspect of it. Of course, we can go physical, but we have to expire. Well, before those moves happened in 94, 97, the futures in the US stayed normal, copacetic. But the EFP, which is an abbreviation for exchange for physical, which is the spread between spot and the front month on COMEX, let's say it's 30 days. This is 30-day future, right? There would be, like 2 cents. Futures would be over spot. But as things started to happen, the EFP reversed. And so you were backwardated from spot to the first future, not the second or third future. So you can shake it off because it's 2 different countries. It's 2 different worlds. But this would happen on occasion all the time, very short, brief periods of time. This happens in gold and silver. You'll see it reflected in the gold offered forward rates and the silver forward rates. And it's basically people need to lease some silver or gold out. But this was getting sticky. And what ended up happening was, once they realized that this is the tail and this is the dog, this started doing this, and the front month started going up, and the whole thing started tracking it. Mechanically, we're doing that again now. Okay? Now, the EFP now, where the spread between spot silver and front month COMEX silver should be, I'm going to make it up, should be 5 cents contango, right? It's trading 10 to 15 cents backwardated. In a liquid, I don't know if this is good or bad for the market, but I'll just say, in a liquid, non-broken market, something is really, really wrong there. Because, to make it real, if I'm a bank, I'm JP Morgan, I'm a big bank, and I understand the market, and I can trade, I got one hand in London and one hand in the US, that's free money.
Right.
I'm going to take delivery in the US at, we'll use some prices here. I'll take delivery in the US at $18. I'm thinking of gold, right? At $18. I hate when the price is so close like this. At 18, and I'll sell it at $18.10 in London, right? So I'm going to sell it at 18.10 in London. And then in 30 days, I'll take delivery at 18 and I'll make 10 cents. Now, for those 30 days, what do? I borrow from someone in my vault. I say, I'll give you a penny for your silver for 30 days. And the bank guy goes like this. He goes, you want it at 18.10 and you'll give it to me at 18 in 30 days? So basically I have negative carry. I have negative cost. Fine. You can have it at 18.10. I'll buy it for you at 1800 and I'll pocket the 10 cents minus the 1 penny I give to some other, schmo down the road that I borrow it from. Why are they not doing that? You used to just do that all day long. And if you're not doing it, this is the structural problem, the structural chickens coming home to roost, I think. If you're not doing it and you're not that should be snapped back. It should be just boom, this is what it's worth. The financial relationship and the spot relationship should not get that out of whack. Either this contract, and I'm not predicting, but either this contract is really no longer deliverable. It is being delivered, but either people are being discouraged from taking delivery, meaning the bank take delivery and make delivery, or this should snap back. So the market relationship between these two markets is broken. Now, in the past, during Buffett and Soros, when it broke, it was breaking and the banks stopped doing this. They stopped going, sold the physical, buy at 18, sold. They stopped doing that little arbitrage because they kind of knew something was going on. Maybe they didn't know exactly what was going on. Like, somebody's playing a game here. Let's not get in their way. We don't want to lose our customer. And that's what was going on then. So now I'm like, okay, what is this going on again now? And why is no one talking about this in a lucid way? Well, there are far less people out there who understand this stuff anymore than when we started in the business, unfortunately. The other thing is there is a lot of, so I looked for a real reason. And the real reason is there is physical demand. You've seen the story about the allegedly the billionaire out of Texas, the woman who you've heard that story, right? Buying. All right, so there is, regardless of that story is true or not, let's assume that it is, right? What's happened is there's a ton of inelastic physical demand at the retail side that has taken a dent out of above ground coins. And so I talked to a friend of mine who's in the physical market. He said, yes, the physical players in London, the smelters, the refiners, the fabricators, however you want to call it, they need more blanks to make more coins. And so they're willing to pay 10 cents over the futures because they don't care, because they're going to, they're willing to pay more. And I was dismissed. And dismissed was, it's 10 cents over, they don't care, they'll pass the cost on. Well, if they keep passing the cost on, you're going to get this again. Or the COMEX is broken. So that's the mechanical reason that I think, it has to be, put it this way, it has to be on your radar. Now, I'm not predicting, I'm not going out saying silver squeeze, but it has to be on your radar. And when this happens, like it happens before that little run up we had to $30 last year. It happened, it happened. And then what happened is the next day, it hit the COMEX. And I went, here we go. And the market went boom. Now, what I underestimated was the power of the banks to snap it back in place. And they did that. Then JP Morgan, I think, was part of that. They did that by, they put out a report in Europe during New York Times saying that silver miners were overvalued, and the market just went woof. And I went,
remember that well.
Right? How many times have we been like, I'm including you with me, maybe I shouldn't, but how many times have I underestimated the power of that financial authority? And that's what happened, right? So we went EFP, futures went boom, and I went, and we went higher, and then whoosh. I'm like, they did it again. So I'm saying that this needs to be on your radar. And if you see it snap into here this time, this has been doing this little backwardation thing for so long now. that the demand seems never ending. Of course, it's never ending until it ends. You and I both know that, right? But this is no longer a one-time thing. It's a chronic thing. And I think when you take that mechanical aspect that I just overly explained and combine it with the East and the West splitting, the East is physical commodities, not necessarily silver, but physical commodities. The West is futures and financial commodities. If the world is an Exeter pyramid, gold and silver are near the bottom, and all the financializations on the top. You pull silver out of the ground, you make solar panels, and you upcharge all these things. But if you can't get access to the physical and the futures are going to break. That's what happened on the LME with nickel. That's what happened. Somebody said, you know what? I'm not going to honor this future anyway because I don't think they're going to make delivery. That could happen in Western exchanges too, although I don't think it will. I think they'll shut it down beforehand. So the East and West split of physical versus financial, the leverage on $20 billion, this is Zoltan, the leverage on $20 billion of natural gas in Europe is $2 trillion of their economy. So they import $20 billion of natural gas, and $2 trillion of financial deals is done on the back between intermediaries. I mean, it's not like that in silver, but the point is, you at least should have a hiccup that I'm describing here. The question is, will it be allowed to bleed, or will something else take us off the grid? Off the grid. The other thing is, if the demand is moving to the west, I mean to the east, and it is, and the supply is in the west, then the price is going to be lower here than it is there. And we're also seeing that Shanghai is trading at a bigger premium than normal to the west. There's always a little bit of a premium because of salesmen. So we are really bifurcating. Talk about the K economy. Remember that? You know, the stocks are going. The upper middle class is doing fine, and the lower middle class is getting killed. Well, now it's like, the price of oils, the price of natural gas is going up, and the price of your fourth TV is going down. We don't need a fourth TV.
Right.
So what I'm trying to drive home here is that a physical shortage of silver above ground is being factored into the market at the spot level. And this will stay kind of wacky as long as the funds in the US still believe that it's going down. So they'll keep selling it and saying they're basically picking up pennies in front of a steamroller, or nickels in front of a steamroller. But the physical guys that are buying, these aren't guys that are going to sell. So all I'm saying is, at these prices, with this big of a flip in that spread, there's going to be a crisis. And the crisis will be a fund blowing up, a fabricator has a problem, a producer, okay? It ends with producers, by the way, in the US. It ends with the producer can't make delivery, and he has to take a year's worth of production and roll it the other way. That's what Buffett did. So the crisis that could come, and I don't mean to say it's going to happen tomorrow, but I think we're in a slow boil for silver. If we collectively, as investors and as owners and as people who have been through the good times as well, can be a little bit patient and just know that there will be a gold standard of some form again in the world. That will happen very soon. 2 to 3 years, it's going to be on the ballot. Silver benefits as well, because once you have in a big way, once you have a gold standard, you'll have a restriction on gold. They'll tax or something, but you can't do that with silver because it's so industrial. So the gold silver ratio will probably go like 200 to 1, 200, and then it'll go back to 50, something crazy like that. So I think, that's why they call it poor man's gold, because if they make gold illegal, you'll all still own silver. And, look at JP Morgan's position. They're long silver and short contracts. So if this were to happen, all JP Morgan has to say, and anyone like them has to say, is we can't make delivery. It's spoken for that silver. And the COMEX then says, we're suspending physical delivery. And then you have this happen. You have everything goes up, and then the futures drop. And so you have to have your physical if that's the case. That's what's going on. I think this spread has been persistent, too high for too long. Yes, it could go away, but as long as it stays there, I'm a buyer before I'm a seller. Hope that helps.
Yeah, I appreciate you digging into that because we see a lot of the paper selling, which is what's pricing the COMEX, and we hear reports not just of the certainly of that retail customer you mentioned, although again seeing there's a divergence between retail silver and industrial silver, with
Right,
industrial being the bigger part, but we see demand there. And
right.
then mix in, is there going to be a monetary premium for silver? And I guess that's one thing that we talked about a little bit before we hit the recording button, where never imagined there'd be so much money printed, yet it could be diverted into
Yep.
certain asset classes. And do do you see an environment where you do have gold filling some role as money at whatever price that is? Does silver piggyback along with that? um
Yeah, it does. It does. I think it will be easier for them to control the price of gold than it will be for them to control the price of silver once the cat is out of the bag. The cat's not out of the bag yet, but I think the retail demand for silver will actually explode in China. Uh, I didn't realize that they were such big buyers of silver at the retail level, but they are, and it's kind of interesting. Anyway, I don't want to go down that rabbit hole, but I just want to say here, I'll give you something that's going on right now that'll allow us to think about it. If I were a bank or central bank or a bank handling a central bank's business, and Basel III was enacted, and I had to get my derivatives book in order, I had to have cash or carry, no futures. And I needed the price of gold to go down or at least stay stable so I can accumulate it. What would I do? Well, I don't want to use the word spoof, but I would put on a gold silver spread. I would sell silver to buy gold, sell silver. And I've traded these ratios. I trade this. And believe me, banks trade it as well for reasons I'll get into another time. But the silver is the tail. And so when you look at the market now, I'm the bank. I need to buy gold. How can I get it down? How can I get some funds to sell me gold? Well, I'll sell silver. The breaking market, silver drops 10 cents. Maybe only gold drops $2, but it drops and someone's selling it. And so I get to buy it. Now, this is very conspiratorial, but I've witnessed it. I've been a part of it as a victim. I've been a part of it as a witness. And I've actually been lucky on the side of the people that were doing the crazy stuff one time in 2011. So that's something that's been in my head, and I've been watching it. And maybe you don't see the price of gold marching up, but you do see the price of gold relative to silver in an orderly, methodical way going up. Simultaneously, you see a large paper short open interest of silver at Bank of America. Why? They don't seem to be nervous about it. And on top of that, for more evidence, JP Morgan a couple months ago, all of a sudden in the US, recategorizes their gold derivatives from FX, which they shouldn't have been there to begin with, but that's another story, into gold.
right.
And right? So it feels like the West is getting its ducks in a row for a change. And that change is, okay, let's prosecute the JPM guys, high profile, done. Okay, let's get JPM's derivatives back out in the open so we can see it, done. Let's get that gold bought. When the West is done buying gold, the price goes up. And that's when they have enough gold. And when they have enough gold, that's when they probably won't care about the price of silver because they're buying that as well. And whoever has those billion contracts that are short will just say, we're not going to honor it. I mean, that's my paranoid example, but that's why I think that this is a big deal. That's why I think that silver will just become an incredibly volatile proxy on gold. But I'm long more silver than I am gold, and I trade both commodities in futures, both sides. So that's it. I think silver goes to like 50 to 1 when this is over, but it could go to 100, 150 to 1 first. So when gold is remonetized, silver will explode. How's that? That's my soundbite. When gold is remonetized, silver will explode. That's it.
Well, that's certainly some good news to hear. We have a lot of silver fans in the audience, and certainly, I mean, it's been interesting seeing, like you mentioned, how similarly they trade. Often, when there's a spike up or spike down in one, it's in both.
Mhm.
And yet here we have $1,700 gold and $18 silver. So been a little tough for the silver crowd lately, although sure appreciate you explaining the dynamics that are going on behind the scenes, especially with the backwardation and
Oh yeah.
how you see those combining. So
Oh, keep the faith on that. I do want to mention one thing that I think for the silver people, as a silver person, if you don't mind, do you mind?
sure, please.
When the market started getting spooked about recession, say in May, there's a large, what used to be the retail is now the CTAs, commodity trading advisors. Commodity trading advisors have retail clients, high net worth individuals, and they put them in commodities. Well, this is mechanically what's going on right now and has been going on since $22 in silver. When you're an investor who's long stock and is worried about a recession, your CTA guy calls you up and says, don't sell your stock. You'll have to pay capital gains on it. You've been long it for like ever, right? Let's sell something that's economic. Let's sell copper. And they start to sell copper in futures. And then they say, let's sell silver because I'm also long gold. I'm long gold because of the war. And what happens is you have everyone who's 45 and older who has money with a professional advisor is being pitched, sell silver to hedge your stocks. I'm not making this up. This is how it goes. And the CTAs sell your silver, and then silver drops precipitously because there's no futures buying anymore. The funds are like, we don't play anymore. Silver's like, no, we don't care. So the CTAs just push it and it makes them look right, but they're selling it lower and low levels. And then when we get that pivot, which you and I are hoping for as bulls, stocks rally 3% and silver rallies 10% in 2 days. And that's the CTAs. So I want you to know that on paper, silver is unfairly punished because you only have one recommendation out there by every bank in the world, and that is to sell silver to hedge your stock portfolio. So it's a buy relative to stocks for the CTAs in July. Remember when the market reversed from 18 to 20?
Yeah.
That was the CTAs getting nervous. If they get nervous again, it'll go to 22. So the market is artificially low because of the bank recommendations to sell silver and copper as an economic hedge against stocks. So it's unfairly beaten up, and it'll remain that way, which is why we should not be speculating in it. We should just be owning it. That's it.
Yeah, I think those are great words of advice, and certainly not the easiest thing to trade. Although I'll link to that special silver note that you had there, which was a great article and um, quite quite a clinic you put on here today. I feel very
I'm sorry.
blessed.
Well, I got
Blessed.
so into it because you and I were talking before, and it's fun.
Well, it's such a unique time in history where I don't remember so many moving parts floating around together like they are now, and um, tough some days reading some of the news that's coming out there and how it's affecting people. Yet, just really appreciate everything that you explained and put in context here today. And perhaps just before we wrap up, can you let folks know the best way that they can find you and the different research that you're putting out?
Sure. The newsletter, which was started for a couple guys as like an educational thing, is called Goldfix, like the Goldfix in Europe, goldfix.substack. You can subscribe there free, or you can do a paid subscription if you like. But just free is good enough. And I do contribute frequently on Zero Hedge, which is the post I think you were showing before. And you can find me on Twitter, although it doesn't work out that often, under V Lanci Pictures, at V Lanci Pictures. And the reason it doesn't work out so often is because I get suspended from time to time for non-politically correct things, and my feed isn't business. It's more like business and sarcasm and irony. So you may not like the feed, but you may like the newsletter. Let's put it that way. Okay.
Well, there's some good stuff on there, and quite an explanation you offered today. So I can't thank you enough for joining me. And I know you have a call coming up, so we'll let you get running. But Vince Lanci, the professor,
Uh,
well done, my friend. And
that's
thanks
right.
so much for making some time. I think a lot of the Silver fans out there, especially, will really appreciate what you put into context. And hopefully we can do this again soon sometime.
Yeah, yeah, I would love to do that again. I'd love to be asking you the questions next time.
All
But
right. Well, I'll be studying, and again, appreciate you joining me, and we'll look forward to that.
okay. Thanks for having me.
Well, thank you to Vince. Sure was great to get his opinion on how he sees this playing out in the gold and silver markets, especially since he's been trading this for a couple of decades and has a really good handle on some of the things that are happening in the gold and silver markets. And I'd like to mention that he did provide a discount link if you're interested in getting access to his research, which is in the description field below. And also, thank you to Reina Silver, who brought us today's episode. And good news out of Reina last week as they announced that they are getting ready to begin phase 1 drilling on their Medicine Springs project in Nevada, one of the 3 high grade district scale assets that they're exploring. As Jorge Ramiro Monroy of Reina mentions, that they have their permits, getting ready to drill their first targets and further define the project, which Dr. Peter McGaw, well-known geologist for finding silver in Mexico, mentions that 10 of the 13 features they expect to see at a large carbonate replacement deposit have already been in place, and that's before they begin their drilling. Find out more about that at reinasilver.com. With that said, going to wrap up for today, but hope you enjoyed the episode, and I'll look forward to seeing you again tomorrow.